Hi, everyone. My name is Tara. So for this morning, we have quite a few company results. But before we go into that, we have a sector update on the Singapore REITs monthly. And we'll also take a further look into the industrial REITs. For company results, we have CapitaLand Ltd, Dasin Retail Trust, Singapore O&G, Q&M Dental Group, Thai Beverage, CMC Gold Mine, Golden Energy and Resources, and Y Ventures. So for S-REITs monthly, this is our monthly report for August. So just to take a look at where we are today in terms of the REITs performance. So if you can look at the light purple line, which tracks the REITs performance against the STI and as well as the financials and property segments, you can see that it has underperformed year to date, pricing in the macroeconomic headwinds, particularly the rising interest rates. However, if you can take a look somewhere in July, at the end, we can see a slight uptick. This is probably due to the release of the surprise property cooling measures in a sort of flight to quality and flight to safety movement. So here it's the same graph showing the year-to-date performance for the REIT index. So year-to-date, it has declined 1.9%. So yield spread is currently at 2.75%, and this is still below the -1 SD range post-GFC. Bloomberg consensus forecast for 10-year SGS yield at the end of this year and at the end of next year are at 2.62% and 2.88% respectively. So all things unchanged, this will be a headwind for S-REITs. However, this can be mitigated by rental growth, and I will expand more on this in the later slides. On the short end of things, for the 3-month SOR, it's currently at 1.6%. This is close to 10-year highs. And how this would translate for REITs would be the financing costs. So higher near-term financing costs are largely mitigated, as upon our assessment, 33 out of 40 S-REITs have at least 70% of their debt hedged on fixed interest rates. And what's interesting to note is that for this quarter, as compared to the previous quarter, the REITs have actually increased their hedging bets to about 78% compared to the average of 77% last year. And this is considering that their all-in financing cost of 3% has been maintained. So I'll go into the subsectors. For retail, we are neutral on declining tenant sales and footfall, as can be seen in Capital Mall Trust as well as Fraser Centerpoint Trust's latest results. And this is due to e-commerce players gaining market share. As you can see, in our previous report, we had noted that Amazon and Taobao have been gaining market share here through their different events and sales days. And if you can take a look at the right, if you can look at the red line, which is the rental index, you can see that it has been declining. And at the same time, the blue line, the retail occupancy has been increasing. So what this means is that retail landlords have been slashing prices to gain occupancy. So sort of a trade-off between rents and occupancy. However, this is not sustainable. As you will know, this course of action is not sustainable because the retail landlords have their own break-even price levels. However, if they were to increase the rental levels, that would affect the tenants as well, as they have their own internal metrics, which is the occupancy cost, the rentals over tenant sales. So, which is why we are adamant that this would continue to be bane for the retail subsector unless tenant sales and footfall won't increase. So right now it's a sort of a lose-lose situation for both retail landlords and tenants. And also on the right, you can take a look at the retail space demand supply. So among all the other subsectors, retail space, the demand supply dynamics for are actually not looking the best. As you can see, blue bar, which indicates the net annual supply, is way above the red dotted line, which is the historical annual demand. So what this means is that we have a supply glut coming for at least the next 1-2 years. For this year alone, you can see that the blue bar is way above the red line, and for next year, it's still above. And retail sales has also been lackluster, with RSI remaining flat, and declines posted by department stores, supermarkets, and F&B segments. And especially, as you know, F&B is one of the top 2 tenants by GRI in the retail malls. So these are some of the major retail supply. For North Point City, they have already opened sometime last year, and one of the bigger upcoming ones are Paya Lebar Quarter and the Raffles Hotel amendments. For office, we are slightly positive. We have an accumulated call on office. So office rents remain buoyant, as we can see in the recent results at Capital REIT and CapitaLand Commercial Trust. And if you can take a look at the chart on the left, you can see that it has come out of their bottom sometime last year, and right now it's on an upward trajectory. And also demand supply dynamics are in their favor. As you can see on the right, previously I mentioned about the retail demand supply dynamics, so you can also take a look at the same metrics, that the net annual supply is actually below the historical, the net annual supply is below the historical demand. So that plays positively for the office subsector. And also, the office cap rates have gone downwards despite rising interest rates, and these are actually due to the valuers' increasing positive sentiment on recent healthy office transactions. And going forward, the strong demand is still expected from consultancy, technology, and financial services segments. And also another segment to take note of is the co-working space, which is starting to be a bigger tenant in the offices as well. So these are some of the upcoming office supply. 18 Robinson is the only grade A supply coming this year, and for Fraser's Tower, it's actually about 80+% preoccupied. For industrial, we are neutral on slower than expected net absorption, and however, there's still tapering supply after 2017 for the 3 industrial sectors. Later on, we'll be expanding on this. Just to flash through the other sub-segments. And finally, for hospitality, while we currently do not have coverage, we are overweight on this segment on the increasing tourist arrivals and improving RevPARs. As we would know, last year, RevPAR came out of the negative trajectory, and currently it is at a 2-year high. And there's also been a positive recovery in tourist arrivals on the back of annual events such as the Singapore Air Show. And in terms of hotel supply, from now till 2020, the hotel supply is at a 3-year CAGR of 1.3%. And this compares to the previous 3-year CAGR from 14 to 17 of 5.7%. And in June, we had the Trump-Kim Summit. And our sensing from the results briefings is that this was actually a net negative to some of the hotelers, as due to some of the traffic disruptions and cancellations of some of the previous bookings. However, we do anticipate a gradual flow of incoming tourists following the heightened awareness of Singapore as a tourist destination. And these are some of the upcoming hotel supply. And a snapshot of the subsectors. So overall, we remain neutral on the S-REIT sector. So while S-REITs are currently trading below the -1 SD level, since post-GFC, strong rental growth should offset any adverse effects from rising interest rates, as I had pointed out in the other sub-segments, that it's really the retail supply, the demand-supply dynamics that would drive the growth of the REITs. And we maintain neutral on the S-REIT sector, on declining tenant sales and footfall for retail, and slower than expected net absorption for industrial. So for our bottom-up view, it's actually unchanged from our previous report. And for investors with concerns on rising interest rates, you can look at REITs such as CRCT and Ascendus REIT, which we have accumulated calls on. And there's a table with our calls on the other REITs under our coverage on the right. And just to flash through the S-REITs universe that we have. With that, I'll pass it on to Richard to talk more about the industrial REITs.
Thank you, Tara. Yeah, hi, this is Richard here. I'll move on to give more in-depth on the industrial REITs subsector. So we published a report last Friday. Title is Sector Remains Lackluster and Recovery Could Be Delayed. These are the highlights for the sector. So we are maintaining equal weight, unchanged from the previous quarter. Summary for what has happened for the sector is that based on JTC numbers, occupancy has ticked down quarter on quarter. Rental index also has stabilized, but it's also lower quarter on quarter. Rental in general has yet to bottom. General meaning the aggregate level, the aggregate rental index, as well as most of the sub-segments. The only bright spot was Business Park, which recorded its 5th consecutive quarter of higher rental. Tapering of new supply in 2018 is a tailwind for the sector. This is unchanged and has been known since last year of the tapering new supply. But absorption of vacant space remains slow. This is evident from occupancy not going up. So while there's lesser supply, but demand also hasn't outpaced the new supply, and so occupancy has not gone up. And then we also see that manufacturing and export data has already started to moderate, and the outbreak of a full-blown trade war could be the proverbial last straw. So this is one of the negatives that we are looking out for already. There's a slight change to our view from the previous quarter. So in the previous quarters, including the most recent quarter, we have been of the view that rents will bottom by the end of 2018. But now we think that there's a possibility that the bottoming could be delayed to 2019 instead. So this is the table to show the JTC data. What you can see here for rental, let's start the aggregate sector. So rental and occupancy quarter on quarter are both lower. And as well as if you look this way for occupancy is lower for all of them quarter on quarter. But year on year it's remained somewhat stable. And then this is the other bright spot is here where Business Park rental has made its 5th consecutive high. So key takeaways from the quarters on the positive is that the tapering pipeline of new space is maintained. That there has not been any change in that status, but the negatives are quite a few of them. So occupancy across all segments has dipped. The rental index also is lower, both quarter on quarter and year on year. And in terms of the listed S-REITs, most of them reported negative rental reversions. So We have also turned slightly negative from our previous view, in that now we think that people should start thinking about rents maybe bottoming in 2019 instead of by the end of this year. And then what will make us turn positive on the industrial sector, we would like to see evidence of higher rents alongside broad-based recovery in occupancy. And then what would make us turn negative is that a further moderation of manufacturing and export data into contraction and reflooding of supply. So we'll also taking note of how occupancy pans out for the sector. And if there's a sharp drop in occupancy, then that could be a warning signal for investors to start turning negative on industrial REITs. So for investment action, I said it already, maintain equal weight on the industry subsector. The tailwinds, of course, is the tapering supply, but headwinds is negative rental reversions continue to persist in the second half of this year. And as well as we see the moderating of the manufacturing and export data. Rental bottom could be delayed to 2019 as well. So we currently cover 4 industrial REITs. Our 2 that we have on accumulate is Ascendus REIT and Capital DC REIT. So for strategic top-down view, it's exactly the same as last few quarters. So basically it's talking about the exposure to science park and business park properties because of Singapore gearing towards a higher value added manufacturing. So something new we have this quarter is this tactical bottom-up view. So we have done bottom-up stock pick based on some metrics. So from this, we identified Capital DC REIT for the better than average capital management. So the thought process behind this is that in view of the rising interest rates, we want to look at the REITs that are, we would like to look at the capital management metrics for the REITs. And so we are looking at the gearing, the debt maturity profile, the cost of debt, their interest coverage, and how much of their debt has been hedged onto fixed rate. So that's the right half of this table that you're looking at now. And then the color code is that for REITs where that metric is better than the average, then the cell will be colored green, and when it's worse than the sector average, then it'll be colored red. So take note for gearing, which is this column, and then the cost of debt. If the REIT is below the average, so is better, and so is the cell be colored green. And then for debt maturity, interest coverage, and percentage hedged, if the REIT has a number bigger than the average, then that cell will be colored green. So looking at this table, you can see that only one REIT, which is a Capital DC REIT, has all the 5 metrics green. That means that based on these metrics, it's better than the sector average. So take note that this is just a bottom-up pick using these metrics. So it's historical numbers and does not take into account anything that's going to happen. It's not forward-looking. Now we'll talk about more details of the REITs under our coverage. So first, for cash, we had a rating change from accumulate to neutral. So we downgraded the rating and the target price. This was because of the higher than expected property expenses, which we had underestimated. This is the impact coming from the conversion of CWT Commodity Hub from a master lease to multi-tenancy lease structure. What's going on for cash at the moment? They're doing their portfolio rebalancing, trying to divest the lower yielding assets in Singapore and then buying Australian assets. So this quarter, they had the conversion of CWT Commodity Hub. Sorry, it was converted in April. It was at 86% occupancy, and then but there was some positive uplift in this committed occupancy to 92.7% by the end of this quarter. Gearing also has been lower to 35.3. This came about after they sold our properties and used the divestment proceeds to pay down debt. So their gearing is marginally lower than the sector average of 35.6. So renewal risk wise for second half of this year is quite small, only 3.1 of gross rental income for the portfolio. But take note that next year, 2019, is quite a concern. There's a 28% of portfolio is up for renewal. Most of it will happen in the first half of this. Most of it will happen in the first half of 2019, and the peak is actually in the second quarter. Next, for Ascendas REIT, so it's operationally stable. Take note that Ascendas REIT has a large portfolio, and so is quite diversified and insulated from any localized negative effects. Occupancy is slightly slightly lower quarter on quarter to 90.5, but the WALE is 4.1 years, which is healthy and higher than the sector average of 3.7 years. A long WALE gives you a longer visibility for the income. From a top-down view, A-REIT is exposed to business park and high specs properties in Singapore, and 55% of its net property income is derived from such properties in Singapore. Also in the quarter, A-REIT made its maiden entry into UK by purchasing a portfolio of 12 logistic properties, and then so they have diversified their exposure outside of Singapore and Australia. Keppel DC, they've also strengthened their balance sheet. We'll talk first about their portfolio. So previously, the manager had already articulated that the target is to grow AUM to 2 billion by the end of this year. So currently, AUM is already at 1.94 billion. So effectively, the target has been met already. So now sources of inorganic growth that will continue to contribute in 2018 are Keppel DC Dublin 2, Main Cubes, and Keppel DC Singapore 5. For third bullet point is actually talking about what I presented in a few slides ago. It's currently the best in class among the industrial S-REITs in terms of capital management and interest rate risk management. That's the table which I showed just now with the green and red cells. Lastly, for Mapletree Industrial Trust, it's still ramping up on its high-tech strategy. So first is 30A Kallang Place, which was a property that has undergone AEI to become a high-tech building, and is currently ramping up its occupancy. It received its TOP in February this year. The other one is the build-to-suit data center, which also has received its TOP, and it has been renamed to Mapletree Sunview 1. Last is they acquired this 7 Tai Seng Drive from their sister REIT, Mapletree Lock. This was completed on June 27, and is going to be upgraded to a high-tech building. So based on the description of what they plan to do, it's likely to become a data center as well. Okay, I'll just run through these slides, the next few slides quickly. So they are the charts for the data for JTC. So on the left, you can see the caption. By looking at the caption, you can see is industrial sector occupancy has ticked down quarter on quarter, but it's roughly unchanged year on year. Rental index makes a new low, but but seems to be stabilizing. Factory wise, multi-user made a new low for occupancy, while rental index is showing signs of stabilizing. Business park occupancy is relatively stable quarter on quarter, and as mentioned earlier, the rental index has made a fifth consecutive new high. Warehouse, as usual, one of the laggards, is a second consecutive quarter of decline for occupancy, and rental still looking for a bottom. So this is a pipeline, 1.08 million square meter of space is expected to come on stream in the second half of this year, potentially increasing current stock by 2.2%. And then for 2019, about 904,000 square meters of space. That is about 1.9% of current stock. So take note that average annual supply and demand for the past 3 years was 1.7 million and 1.8 million square meters respectively. So what you can see is, for example, 2019, the 904,000, that is significantly less than the 1.7 million average for the last 3 years. Okay, now we look at some of the manufacturing and export data. This is showing up to June this year. So as I mentioned, they're showing signs of moderation as well. The left chart shows that PMI has actually been trending down during first half of 2018. It's become already lower than the peak of 2017. And on the right, you can see that electronics production growth is slower this year compared to what it was in 2017. And then for the chart on the right, electronic Nordex actually has been in contraction for the first half of this year, and there wasn't any growth. So based on this, it looks like industrial activity might be slowing, and then that doesn't bode well, considering the fact that occupancy isn't picking up already and hasn't been able to offset the hasn't been able to capitalize on the tapering pipeline of space. So there's currently a broad expectation for rents to bottom in 2018, but based on these factors, we think that it could be delayed to 2019. This is just a table showing how the various REITs fared during the recent quarter. And then here's a table to show what we want to highlight is the valuation as well as the yield. So as usual, this table is showing how the sector has fared over the last 4 quarters. And then you can see year on year. So if you look at last year, 17 August, the price to NAV was about 1.12 times, and the yield was about 7. Today, it's also still about the same. If you just scan through across time, the yield has maintained relatively stable at 7%, and in terms of price to book wise, seems to have gone up across time, but then has compressed in this recent quarter. Okay, so for this chart, we always show it as well. It's just to show that you can normally find that the larger capitalized REITs, the blue chip blue chip industry REITs tend to trade at a tighter yield and a higher price to book. One of the noteworthy change across the quarter is that Ascendas REIT has also moved towards the right at a higher price to NAV multiple. Okay, now we'll move on to Teo Hong, who will talk about CapitaLand.
Thanks, Richard. Good morning, everyone. Teo Hong here. I will kick off the results highlights with the property sector first. So first up, we have CapitaLand. Their second quarter results. I think a summary of the numbers is that if you look at the gross revenue and the EBIT, these are numbers which jumped a lot, about 40%. But I think this can be a bit misleading because starting from 3Q last year onwards, they have consolidated the revenue from CMT, CRCT, and RCST. Based on our estimates, if you exclude the effects of all this consolidation, the EBIT from the recurring income segment could have grown about 20%. And also do not be too alarmed by this increase in finance costs as well, 50% jump, but that is also primarily because of the consolidation effect. And if you look at the average cost of borrowings for the group, it has stayed pretty stagnant. It is now 3.1%. Last year, it was 3.2%. So all in all, I think some of the positives we can derive from the quarter is that you saw that recurring income growth was there, because if all of you can recall, last year in the second quarter, they actually opened 3 Raffles City in Shenzhen, in Changning, and in Hangzhou. So this actually helped drove recurring income growth. They also had a $3 billion annual asset recycling target that was set at the end of last year by the CEO, Lim Ming Yan. And already as of first half, they already had more than this amount of asset recycling done. And I think one of the more notable divestments that they had is the 20 Anson office building that was sold at about 20% higher than the last valuation. I think this kind of asset sales are further testament or evidence of the kind of value that they are carrying in their balance sheet. In terms of some of the operating metrics for the biggest sectors that the group is facing, we all know that they are very exposed to the retail segment in China, offices in Singapore and China as well, and then service residences as well. So looking at some of the operating metrics in these key segments for them, retail sales in China, overall retail sales for the group has grown 20%, but that is on a group basis, including all the newly opened malls. If you take that out on the same mall basis year on year, that has also been quite stable at about 5.4% for China. And if you look at that number for Singapore, it will be more on the flat side, maybe one low single digit number of flat. So in China, is for mature malls, same mall tenant sales pretty stable at 5.4%. And then on the service residence segment, their RevPAR actually grew 4%. The strongest sector was again coming from China. That region actually helped to offset some of the weakness that has been seen in Southeast Asia and the Australian region. And one of the negative for the group is that some of the projects in China which were slated for launch were delayed because of the approved selling prices on the ground that has not met the management's desirable selling price. And I think in terms of outlook, you can see that the group has already sold 4 billion worth of residential inventory, predominantly in China, some of it in Vietnam. We estimate that close to half of this will be recognized in the second half of this year. And so you put that number will be down to about 2 billion. Every quarter will be about 1 billion. And that is already more than 80%, about 80% of what they have put in this year. And that is still excluding the recurring income segment. And the second point to note is that some of the operating metrics for the group's recurring income portfolio, which occupies more than 80% of their total assets, and these operating metrics are actually stabilizing or showing signs of improvement. So the next one I have is Hobby Land. This one is we are still maintaining accumulate target price is unchanged. I think some of the highlights from this numbers will be that the the acquisition that they made in June this year, just 2 months ago, that partial contribution from that one, and then the UK acquisition as well. This has led to a growth in the rental income. There was also a fair value gain, 28 million from the sale of one of this petrol station site in Bukit Timah. But all in all, I think if you look at their main assets in Singapore for rental, that is the Metropolis, that was contributing about 55% of rental income before that acquisition they did in June. That building has been very strong all the way since they opened in 2013, close to 100% lease as well. And then so for the leases that are expiring this year, over the next 1 year, management's expression is that at the minimum, rents will maintain at the same level. And some of the negatives will be that there was a 44% increase in financing costs because of the net gearing ratio increase from 0.4 to 0.8 currently. And this is because they took on a debt of about $1 billion to fund the acquisition of the UK office building. And another negative is that the 3 Sentosa condominiums that they have, the launch in the last quarter's results, they mentioned the launch to be in this year. I think going by how the situation on the ground is, we estimate that this launch could potentially be delayed again, because for properties in that on Sentosa Island itself, particularly for their 3 condominiums, you are looking at close to 40% of buyers being foreigners, and this group of buyers will likely be the hardest hit by the ABSD adjustment on the 5th of July. So that one, we will expect that the launch date will be potentially delayed again. The outlook is that the recurring income portfolio is stable because, number one, the UK properties are stable because of the long WALE. If you look at the latest one they acquired, the WALE is 10.5 years. Metropolis, because of the dearth of the office supply, grade A office supply in suburban Singapore, and also because the general office market in Singapore is recovering, so that should be put along as well for the Metropolis. This is one stock that is having one of the steepest discount to NAV at 45% amongst all the developers listed here. And this is also below the post-GFC average price to NAV of 0.6 for this counter. We estimate that the recurring income actually can cover about 3.3 times the ordinary dividends they declared, that we estimate that they will declare in this year. So for this above 2 counters will be that for those of you who have clients who are still having a negative sentiment on the local residential market, these 2 counters are amongst our coverage, those that have the lowest exposure to the Singapore residential market. CapitaLand has only Pearl Bank, that is less than 3% of total assets on the balance sheet. Pearl Bank is one. Last week they won another site at Buangkok. That one is small by their standards. Total size is about 700 plus million, the cost of it, and they are sharing this with CDL. So each one of them probably 300 over million is also not huge. So CapitaLand's exposure to local resi will be just predominantly these 2. And then Hobie's one will be for the Sentosa condos, and that one is currently about 14% of our calculated gross asset value. Okay, with that, I'll pass the time back to Tara for Dasin.
Hi, so Dasin released their Q2 18 results sometime last week. So gross revenue and NPI are still seeing big increases of 65% and 84% respectively, mainly due to the contribution of Shih Tzu Metro Mall, which was acquired in June last year. So next quarter onwards, we should see purely organic growth. So even stripping out the contribution from Shih Tzu Metro Mall this quarter, we are seeing organic growth of 10.4% from the other 3 malls. 10% of their leases by GRI were renewed in the first half of this year, with 12.2% positive reversions and 100% portfolio occupancy for all four of their malls. WALE has also lengthened to 4.07 years. And for the next half of this year, there's still 17.9% of leases due for renewal. So while this poses some concern, the managers there has been evidence of the managers' execution of these lease renewals, and so we expect positive rental reversions to maintain in second half of this year. However, gearing has increased slightly to 31.5% on the back of a decline in valuation of some of their investment properties due to lease renewals of anchor tenants. So even though gearing has increased slightly, this still affords them a good amount of debt headroom to pursue inorganic growth through its ready ROFR pipeline of 20 properties. Fundamentals remain intact, and we downgrade our call to accumulate purely based on the recent price movements. So as of the date of the report, the last price was 90 cents, and we maintain our target price of 97 cents. Next, I'll pass it on to Mei Ying to talk about Singapore O&G.
So for Singapore O&G, we've upgraded our call to buy an unchanged target price of 0.42. And this is based on a FY18 earnings per share of 1.82 cents and a forward PER of 23.2. So for the positive for SOG for this quarter, it's the O&G segment. It continues to gain market share. So it has 4.8% of Singapore's total live births as compared to 4.1 a year ago. And their O&G, the babies delivered, is actually rising as compared to a rather flat rate of Singapore's birth rate. And the cancer segment also profited quite well. It doubled in profits, and the earnings before interest and tax from the O&G and cancer segment actually more than offsets the challenging dermatology segment and also the startup costs incurred by the pediatrics segment. So for the pediatrics, for the cancer related, the EBIT margin expanded mainly because the more of the specialists actually broke even in FY18, and they got more patient load as well. And also, SOG has a higher interim dividend payout for the first half of 2018 as compared to last year. So for the negatives will be the dermatology segment. It's actually still quite flat. This is mainly due to the slowdown in medical tourism. So SMG is currently putting out more marketing efforts to target overseas customers to bring this foreign patient load back. And also the new pediatric segment, which started last year in July 17 and November 17. So we expect both pediatricians to break even by the end of FY18. So for outlook for SOG, cancer and the O&G segment will improve as more doctors break even and gain more patient load. And also SOG is also actively seeking suitable doctors to join them. And they are looking at 2 to 3 new specialists by the end of this year, especially to the pediatric segment. So with a robust balance sheet with zero debt, it has a stable market position. For Q&M Dental, similarly, we upgraded to buy with a higher target price of 0.65. And this is mainly due to we increased the PER from 27 to 28. And 28 is in line with the peers, excluding the hospitals. So for Q&M, the main positive is the aggressive expansion plan is finally underway. For the first quarter, we saw 0 new clinics, but for the first half, they have announced that they currently have secured 4 new rental agreements in Singapore and also 3 new rental agreements in Malaysia. But their target for the end of the whole year is 10 new clinics. So for Singapore, there's already 3 open as of first half, and they have secured 4 more rental agreements. So for Singapore, there's 3 more that they need to open in the second half. And for Malaysia, as of first half, there was 0 new clinics, but they have already secured 3 rental agreements. So for Malaysia, in the second half, they will still have to secure another 7 new clinics to hit this target. And also the organic growth for their business, distribution business, is mainly due to a company in Malaysia. And also they have a new interest savings for their refinancing of the MTN loan. So they have secured loan 60 million in loan from 2 local banks with a lower interest rate. So the management have also supplied that there's an interest saving of around 1 million a year. So negatives will definitely be the challenges in Malaysia. They will have to open 7 more new clinics in the second half. So our outlook is we are cautiously optimistic on the expansion plans to plug the gap from the deconsolidation of Housing and also ITTER. And with 24 new dentists recruited in the last 3 to 4 months, this will contribute and push the expansion plans along for Malaysia and Singapore. So we also do not discount that the possibility of expanding into southern China through the Housing associate, and Housing already has a strong presence in China. So all in all, we upgrade to buy for Q&M Dental. So now I'll pass on to Paul for Thai Beverage.
Yeah, hi. This is Paul here. Just on Thai Beverage. No money, no spirit. I guess that's the whole gist of the results. Okay, we downgraded Thai Beverage to reduce. The negatives was, as you can see in the red box, sales volume has been very weak. Because there have been 2 acquisitions, so the headline numbers will mask what is happening in Thailand. So what's happening is that, as you can see, sales volume for the spirits, and spirits is the core business. Spirits accounts for 70% of the profits, and this is where we saw a 11% decline in revenues. The main reason is just poor rural demand in Thailand. As you may know, the consumption for spirits, predominantly the brown spirits, come from the rural sector, which is dependent on agriculture prices and also fishery prices. So that has actually hurt the volumes. And on the beer business, the headline numbers is huge because of the Sabeco acquisition. But if you remove that, it's also down 9% in the third quarter, which is basically the June quarter. Beer was surprisingly sluggish despite the World Cup. And the contribution from Sabeco, when we work backwards, is actually very minimal to the earnings because of the huge 1 billion per quarter interest expense. The only positive was that Sabeco, the revenues were actually up in local currency terms, because Sabeco, as you know, is listed in Vietnam. So you can actually draw the numbers, and it was actually, it rose about 12%. We downgraded to reduce any revival in the spirits demand will only come if you can get some improvements in the agri and fishery. They still have very dominant market share. They're still leaders in the spirits business with 90% market share, but just that the macro situation is quite weak. What they did mention was that any near-term stimulus could come if there are national elections next year, because that kind of will reinvigorate some economic activity in the country. These are just 2 slides. We do monitor the situation. The most important is, of course, the farm income index. This is the Bank of Thailand, which is the central bank, actually has they do monitor how much are the so-called farmers' income levels, which is based on the agri prices. So this is still a bit very sluggish. So if we see some big pickup in this could be a harbinger, or at least a lead for us to maybe upgrade the stock. But in the near term, it's still very sluggish. And the management also even mentioned that in July, the numbers still look weak for them. And the rate is, of course, the Thai consumption index, which is a broader index which includes the urban sector, which was also surprisingly weak. Some of the reasons mentioned is because of the high household leverage in Thailand, and also manufacturing activity isn't very robust, and according to them, this is their words, that there isn't much overtime wages and so forth for them to boost discretionary spending on alcohol and so forth. This is just a snapshot of the domestic beer sales, which is released every month. Again, this is all in negative numbers, so the situation is still quite weak for Thai Beverage in Thailand. Okay, I think Guang Che is not here. I think we will end because he's gone for another briefing. So we will open up for questions now. Yeah, we have a question on for Thai Bev, does the contribution from subsidiaries like FPL make any significant impact? Not really. As you can see, they do give a segmental, but most of the earnings still come from the spirits and the beer business. But just as a side note, there are plans for some restructuring of the whole property business between FPL and Thai Breath, but that is still up in the air. But just to answer, yeah, FPL is still not a meaningful contributor yet. Yeah.
For a question for SOEG, if there are any plans to expand overseas, we've asked management a similar question as well, but for now they are concentrating on expanding in Singapore only. Yeah, not much plans for overseas yet. And for Singapore, mainly the expansion they're concentrating on is in pediatrics and also cancer-related segment. And another question for comparing SOG to ISEC and Singapore Medical Group, because we do not cover those two, so we can't really gauge which one is a more attractive buy.
Okay, for Thai Beverage, another question on for Thai Beverage, with the weak performance, do you think they can achieve their Vision 2020? As for Sabeco, when do you see the positive contribution? I need to double check on their Vision 2020, but in terms of Sabeco, it will take some time to get any meaningful contribution. I think they need to wind down a bit of their debt. One possible way is because Sabeco is in a net cash position, so they could upstream some of the dividends up to Sabeco. But do note that as a reminder, there are some outstanding issues with Sabeco, because this is a legacy thing. But the government has actually claimed that Sabeco still owes them some dividends. So this is also a bit of an overhang on Sabeco. The management didn't want to mention much about this, but basically, in a nutshell, Sabeco has some outstanding dividends which is being claimed by the government, which is being disputed by Thai Beverage. Okay, Thai Beverage last target price was 107 versus now 62. What was the oversight? Okay, that was a different analyst, but anyway, what has happened was the weakness in Thailand was worse than we thought. I think expectations was that at the very least beer could recover, because do remember that in last year was a mourning period, so it was expected to be weak, and we expected number one, that the demand would come back up after the mourning period for beer and spirits. But number one, that didn't happen. The other surprise was that despite the weak demand, they actually still maintain quite a very high operating expenses for their spirits business and also their beer business. They weren't. I mean, was repeatedly asked, but they didn't seem to be very clear on what was the reason. Apart that last year they underspent and now they are beefing back up their spending. So that is also another trigger why the margins actually kind of collapsed in this quarter. In terms of the valuations, we didn't give the details in the report, but what we do is we benchmark the EV/EBITDA of the company to all their various to all the global peers. So we used to take the average, but in view of the weak performance, we actually just benchmark the valuations to the lower band of all the global peers. So that was the reason. Okay, on Thai, sorry, the other question I missed, right? Thai Beverage, what is the status of their KFC business? I think their KFC business is doing reasonably well, but this was also being burdened by the high interest expense. And actually, their the food business also, the earnings was also weak because of the high interest expense. So these are all very good businesses, but I think it just takes a bit of time because of the high. I mean, Sabeco wasn't bought at a very cheap price, neither was KFC. So all these businesses are being burdened in the near term, at least by the high interest rate. So it takes some time to clear. As you know, consumer is a high cash generative business. So it takes time for them to pare down the debt, and that's where you can get another kicker to the earnings. But in the near term, this will weigh down on their net profit.
For the question on where to find the slides, you can go to Stocks BNB, the homepage, and then when you scroll down, you can see latest webinar. We also upload the PDF there.
Hi, so there's a question on which REIT would benefit from the Smart Nation initiative. So I think earlier in the slides about industrial REITs, we can see that a top-down view for industrial REITs is that Singapore is evolving towards a higher value-added manufacturing, which includes, which is the same tangent as the Smart Nation initiative. So which is why we are positive on Ascendas REIT, Cash Logistics Trust, and Capital DC, which all have high specs, high tech buildings within their portfolio. However, if you look at the recent news, the Smart Nation initiative is actually on hold now with the cybersecurity issue. So yeah. Okay, so as there are no further questions, we will end our webinar for today. Thanks for tuning in.